Our first company-specific question is on RioCan. Specifically, what you think of their real estate portfolio 2020 versus now? What would be your thoughts?
It's night and day in my opinion. 2020 was a rough year. 2021 looks pretty good to me so far. The real estate portfolio has done very well in the last year, and this time last year, that was not the case. The second quarter of 2020 was awful for RioCan. They were getting hammered. Their rents were not coming due when they wanted them. It was down to 73% of cash rents collected this time last year. The company was rolling out rent deferral programs for many of its smaller tenants, and that was on top of government support. So this time last year, it looked pretty ugly, and the second quarter of 2020 was probably their worst quarter in maybe forever.
Wow. And what about full year numbers?
Yeah, it got better in the backstretch of the year, but the full year numbers were still pretty awful. The leverage metrics ballooned on them because their cash flows were shrinking so much. Revenues fell 14, 15%, somewhere in that neighborhood. They cut their dividend, monthly distribution that is, by a third. And the company reported a net loss of $65 million. And $65 million for such a large organization, that might not sound like a lot. But to put it in perspective, in 2019, they produced a profit of $776 million. So that's a massive drop. And then going back to the financial crisis, in 2009, they produced a profit of $114 million. So it was by far and away a much more challenging operating environment in 2020 than it was in 2008, 2009.
No kidding. That is quite the comparison between 2020 and 2009.
Yeah, I couldn't agree more. The operating environment for REITs was just awful, or retail specific REITs like RioCan was just awful last year.
Yeah, and yet you guys bought more, right? In September, you bought it. What was it? $14.75, I think.
Yeah, that's true. We bought it roughly this time last year in September of 2020 when things were looking pretty bad, and we weren't trying to bottom pick it by any means, although since then the shares have almost gone straight up. They're now over $22. And I should actually say Ben was the major driver behind purchasing RioCan at this time last year. He was really interested in getting more of it in the portfolio. So my hat goes off to him because I was interested, but I wasn't confident enough to pull the trigger while he was. So I just went along with the trade, and so far it's worked out quite well.
So why did you guys pull the trigger then? What was the catalyst at that point?
Yeah, so I guess I just told you how awful the Q2 numbers were this time last year, and how leverage metrics were getting worse and all of that. And we anticipated a dividend cut, for example. But when we looked through the balance sheet, it occurred to us that the liquidity was actually okay. The balance sheet was strong enough. The dividend, if it was cut, which we all know now it was, would eventually grow again. And we thought management was being pretty proactive given the scale of the situation. And then finally, we like low-valued and undervalued companies, and the valuations on RioCan this time last year were very low. Regardless of how you looked at it, they were very low. So yeah, that's basically why we bought it and why Ben was driving to get more of it in the vice president portfolio.
Fair enough. Well, that certainly makes sense, and well done, Ben.
Yeah, totally. I couldn't agree more. And he understood the thesis pretty well back then, so good for him.
So any closing comments on RioCan before we move on?
Well, I could pitch an article that I've just written for Seeking Alpha on it. You can check it out there if you wish. And the other thing I would mention is the outlook. I would say the outlook is probably pretty good at this point. So as many longtime subscribers will know, they're more or less focused in Canada's 6 largest urban markets, and their main bread and butter is Toronto. And Toronto's issues in the housing market are meaning that RioCan should do very well. There are low vacancy rates for rental space, for retail space, for office space, and that, when you take it all together, provides a pretty good tailwind for the company, and I suspect its cash flows will chug higher in the coming years because of that.